By 2017, Steinhoff was Europe's second-largest furniture retailer, trailing only IKEA. They operated thousands of stores across the globe, fueled by billions in investments from the public, including the retirement savings of nearly 1,000 South African pension funds. Then, on December 5th of that year, the board released a brief statement citing accounting irregularities. Within days, 230 billion rand in corporate value vanished from the stock exchange. When everyday people invest in the market, they rely on an illusion of safety, guaranteed by elite financial watchdogs. We trust superstar boards of directors to supervise management, and we expect Big Four auditing firms to provide infallible oversight. How did this multi-layered system of elite governance completely miss a 6.5 billion euro black hole for over a decade? The Steinhoff collapse proves that the safety of public markets is a mirage if the protective layers of corporate governance are designed to trust rather than verify. Marcus Jooste, Steinhoff's CEO, was the central architect of the deception. He built a small, loyal inner circle and directed them to execute transactions that existed entirely to inflate the company's asset values. The fraud operated through a network of secretly controlled, supposedly independent shell companies in Europe, with names like the TG Group and Talgarth. They used these entities to fabricate sales, shuffling fake debt around to mask failing retail operations. In one instance, Jooste's accomplices simply hand-wrote a fake invoice to create 23.5 million euros in revenue. That single piece of paper was then logged into the official books, instantly conjuring hundreds of millions of rand out of thin air. This chart exposes a glaring accounting flaw that should have been caught. While Steinhoff reported massive, escalating profits year over year on paper, the actual cash flowing into their bank accounts remained completely flat. The money never physically arrived. This deception succeeded through a blatant shell game, sustained by the sheer audacity of the executives and the blindness of the observers. Steinhoff's first line of defense was its board of directors, a group packed with seasoned banking executives, governance experts, and 3 directors holding PhDs in accounting. Jooste managed them by tightly controlling the flow of information. He starved the board of actual, raw financial data, instead delivering heavily doctored presentations while projecting total confidence. But why didn't these financial experts notice the missing cash? A tick-box compliance culture had infected the board. High compensation and professional prestige discouraged directors from asking obvious, confrontational questions about the missing cash flow. When social dynamics, deference to authority, and financial comfort override fiduciary duty, a board of directors transforms from a protective watchdog into a passive shield for fraud. The final layer was Deloitte, Steinhoff's external auditor for 2 decades. They were legally mandated to apply professional skepticism, an attitude of critical assessment, and a questioning mind. Yet for years, Deloitte missed glaring red flags. Steinhoff consistently recorded massive one-off profit injections right after their financial year ended, which artificially saved the balance sheet at the last second. The breaking point arrived in late 2017, when Jooste tried to force through a fake 740 million euro deal with the American mattress company Serta Simmons. This time, the auditors pushed back, demanding signed agreements and valuation reports. Jooste stalled, offering only verbal explanations instead of hard evidence. Jooste then deployed psychological pressure, loudly complaining that the world had gone crazy with compliance and attempting to bully the auditors by blaming their queries on a disgruntled former partner. Decades-long relationships between auditors and massive clients inherently compromise independence. Firms are incentivized to prioritize long-term client relationships over their duty to uncover the truth. In late November 2017, the standoff reached its climax. Deloitte finally held its ground and refused to sign off on the accounts without physical documentation. Jooste attempted one final bluff, jetting off to Germany to retrieve the missing documents. He never produced the evidence. Instead, Jooste suffered an alleged emotional breakdown and resigned abruptly via a text message to the chairman. As the company officially admitted to the accounting irregularities, its stock value evaporated instantly. Massive corporate fraud operates like a vampire. It can survive for decades in the shadows, but it burns up the moment absolute physical proof is demanded. In the wake of the collapse, the public expected the professionals who enabled the fraud to be swiftly disciplined. Instead, corporate secrecy has blocked justice. Professional bodies like SAICA have been paralyzed because companies hide forensic reports behind claims of legal privilege. The auditing industry has fallen back on its ultimate defense, the expectation gap. Highly paid firms claim the public simply expects too much, and that finding fraud isn't actually their job. True accountability in the financial system is impossible as long as watchdogs are allowed to hide their negligence behind corporate secrecy, leaving the public as the only entity forced to pay the price.